Good morning and welcome to this Wednesday, May 4th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it's Fed Day. It's probably the biggest news. I think it'll be somewhat anticlimactic, though, in the sense that the Fed has pretty much announced it's going to raise 50 basis points. So I think that's what we should expect at 2 o'clock. But I think it's more than that. I think we'll also maybe get a little bit more of their game plan as they continue to fight the inflation surge that we've seen since the pandemic began back in March 2020. I still believe that we probably have peaked in inflation. We're going to see whether or not I'm right. I think with the last reading, that's going to be the highest reading we're going to see. And my basis for that is that the next 3 months will be replacing 3 months from last year that saw huge surges in core CPI. So, and I'm not talking about the headline number. Headline number gets influenced by a number of things, especially a very volatile energy and food group. I'm talking about the core inflation level, and that's what the Fed pays the most attention to. And I see the number coming down over the next 3 months. Hey, if I'm wrong, I'm wrong, but I see it coming down. And it's going to be very interesting. We're already starting to see a little bit of rotation back toward some of the more aggressive areas. I'll show you some charts in just a couple of minutes. But going to be a very interesting, not just day to day, but the next, next couple of weeks to couple of months, seeing how this market plays out. I believe that we're probably going to see lower prices. I'm not 100% convinced of it, but I'd say maybe 75, 80%. I think we go below 4,000, maybe as low as 3,500. I don't know if we get that far or not. But I think there still is a chance. Let's see what happens today when the Fed makes their announcement, see where the money rotates. I think there's still a chance that the market has put a bottom in. But it's, and we talked about this from back in December of last year. I mean, where we are now is what we talked about 4 or 5 months ago. So we shouldn't be too surprised. The market was setting up for this. But you also need to realize the news is going to be bad for a while, but the stock market doesn't wait for the bad news to end before we go higher. So anyway, there's a lot, obviously, to watch over the next several weeks as we move throughout the summer. Historically doesn't really favor the market here through the summertime. Maybe we'll have choppiness, but history doesn't prove out the same every year either. These are tendencies. These are not guarantees when we talk historical tendencies. All right, let's first bring up earningsbeats.com. For those of you that are new, always like to start here. Go to earningsbeats.com, scroll down. Love to have you join our Earnings Beats Digest newsletter. Name, email address, and hit that subscribe button. That's all it takes. No credit card required. You can unsubscribe at any time. We publish it 3 times a week, Mondays, Wednesdays, Fridays, normally around 8:30 in the morning. Very quick read, just a couple paragraphs in a chart. So very simple. But I do think it conveys quite a bit of the things that are important to us, like earnings, gaps, candlesticks, trend lines, moving averages, the relative ratios, the intermarket analysis that we do. We feature that from time to time. Anyhow, I think this is a great way to learn a lot about earnings beats, the way we approach the market if you're interested. All right, so let's talk a little bit about what happened on Tuesday. The Dow Jones Industrial Average finished up 67, S&P up 20, NASDAQ 27, mid cap 24, small cap 11. We were up, but I'll be honest, I was kind of disappointed with the action. I mean, when you've seen our previous bottoms, when we've seen the S&P 500 bottom and then reverse back up again, and normally we get quick reaction back into some of the aggressive areas of the market and make for a pretty quick run to the upside. Here we did stagger a little bit in January before we finally made a move. We came down in February and went straight back up. Then when we put in the final bottom in the middle of March, we went straight back up. We really didn't hesitate a whole lot. So yesterday's action, it looked like coming off of a lot of hammers that printed on Monday. I was just expecting this gap up. Maybe we pull back in the morning and then we just take off. And didn't really see that. Didn't break down again. So it wasn't horrible. It just wasn't great. It wasn't, really big surge. And I would have liked to have seen that. Would have been a lot easier to evaluate for sure. Had we surged to see where the money was going and that sort of thing. Maybe we'll get that today. A lot of earnings reports coming out. We'll talk about some of those in just a minute. But overall, I mean, it was an okay day. Again, just maybe a little disappointing off the big reversal, the VIX hitting 36 on Monday. It's like, now's the time. Let's go. And just didn't quite do it. Energy led 2.88% higher. So pretty big move there, back clearly above its moving averages. Looks to keep this uptrend in play. Also notice energy. We had negative divergences out there, higher prices, lower PPO. And we went down, hit that center line, went down, hit the 50-day moving average. That's what I consider a reset after a negative divergence prints. And so the analogy for me is like when you have a baseball series. If you're familiar with Major League Baseball, they play like Friday, Saturday, Sunday, 3 games. The first game on Friday, your team might be having a horrible game. You might lose 9-1. Well, when you come out on Saturday, you don't start off down 9-1. You reset. You're back to 0-0. Who's going to win? I don't know. It's even. That's the way I look at these divergences. Once we get back to center line, momentum's gone. Here, you could see momentum was slowing. But once you get to the 0 line, there is no momentum. Based on the PPO or the MACD, you're looking at the difference between the 12 period and 26 period moving averages. That's what shows up right here. When it's at 0, your short-term and longer-term moving averages are identical. So the short-term isn't showing us any momentum one way or the other. The score's back to 0-0 here. So when I see negative divergences, sometimes it can start a lengthy downtrend. Other times we just get a reset and then we start right back up again. So I like what's going on with energy right now. I mean, there's no reason to be upset with what we're seeing here. I would say maybe $70 would be a major support level on energy, the XLE. And we're trading in this range. Recent highs, 82, 83. The lows at 70. We're sitting at 78. But we're starting to trend back up. That PPO is turning up again. So I think energy looks pretty good here. Notice also, even though we pulled back, look at the AD line ready to break out again. Financials also up 1.3%. And if you notice the 4 groups that are leading or that led yesterday, the only one that was aggressive was financials. And that's why I didn't get overly excited by the reaction yesterday. There was just no, where's consumer discretionary on this list? Where's technology? Where's communication services? Nowhere. They were leading on that reversal on Monday, but then there was no follow through on a relative basis in those groups. Again, we'll look at some of those relative strength charts in just a minute, but that was one of the reasons I was a little disappointed with the action yesterday. Real estate materials also up over 1%. So there were your 4 groups that led to the upside. Staples were down yesterday. That was the worst performing group. Consumer discretionary didn't do well either. So both consumer groups did not do particularly well. Staples, however, back down to the 50-day moving average. This is where I'd like to see this group start to turn back up again. See whether or not that's the case today. 10-year Treasury yield. Let's get an update here. And while I'm doing that, let me go over the April ADP employment report, which was out this morning. Now, I don't pay as much attention to this one as I do non-farm payrolls on Friday. But the April ADP employment report showed 247,000 jobs. That was an actual number. Market was expecting 398,000. So we came up a little short, but we're still positive. With the GDP, first quarter GDP turning negative, what we really don't want to see are jobs all of a sudden falling apart and we start seeing negative numbers on jobs. So far, even though it was below expectations, April numbers still okay. We'll see what happens with the April non-farm payrolls on Friday. But a big question is, can we have a soft landing in terms of the economy with the Fed, rising inflation and the Fed getting so aggressive now and raising rates? Normally, that does not bode well. A hawkish Fed normally is not good for stocks. So can we, get inflation under control, whatever the Fed defines that as? I think naturally slowing the economy is probably a pretty smart thing because it slows demand. I mean, if you think about economics 101, inflation is simply too much demand for too little supply. And we've had the supply chain issues, and we've had this, I think, surge in demand because everybody was stay at home, locked down. I think everybody just wanted to get out, spend money, and do things. And so we saw that combined with supply chain issues from being locked down in 2020. A lot of areas of the market still haven't caught up. So that's the combination. Well, as time goes on, we're going to catch up on the supply side. And the demand naturally is going to come down with the Fed raising rates. So I think it's going to take care of inflation. And when inflation appears to be under control, we're going to start seeing it by rapidly decreasing 10-year Treasury yield. I think everybody's going to want to go back into bonds once inflation scares over. So that's going to be one thing certainly to look for. But watch these aggressive stocks. Consumer discretionary, technology, communication services, maybe the industrials as well, financials maybe to a lesser degree. But these are all areas that should do well once the market believes inflation is under control and rates are either peaking or near a peak. So that's going to be very important, I think, going forward. The FOMC announcement today at 2 p.m. So if you're live under a rock and you didn't know, the Fed will be announcing its latest policy decision at 2 p.m. today. And it is widely anticipated they're going to raise 50 basis points. I think anything other than 50 basis points would be a shock at this point. You got Fed Chief Powell and all his cronies at the Fed. They've all been out touting 50 basis points. And it'll probably be a unanimous decision. Beyond that, though, what are they going to say? That's going to be the key to this report, 2 o'clock. And when you look at the market, when a Fed announcement comes out, the volatility that usually takes place from 2 o'clock to 4 o'clock can be off the charts, no pun intended. But you've got usually an initial swoosh one way or the other. That's usually not the right one. Rarely do we just see the market head in one direction after the Fed meets. Usually it's a big move in one direction, another big move in the opposite direction, and then we try to figure out from there where we're actually going. So just be ready for whipsaw action at 2 o'clock if you're trading. And if you're buy and hold, then it's like any other day. Wouldn't worry about it. Okay, let's talk about the S&P 500 and go over some of these relative charts that I was referring to. So this is a chart of the S&P 500, and then down below, I've got all 5 of the aggressive sectors relative to the S&P 500. And this is a 3-month chart. Actually, I'm going to stretch it out. Let's make it, I don't know if it'll go out 6 months. Let's see if we go out 6 months here. So this is all the way in November of last year. Now, what I want you to focus on is when we made this last rally here on the S&P 500, right here, normally what happens is we are led by technology, consumer discretionary, communication services. And if you notice, the last set of highs here on the S&P were accompanied by lows on the relative strength of technology. Relative strength of consumer discretionary also had taken a toll. Communication services have been going down for a few months at that point on a relative basis. Industrials at beginning of January were downtrending, and financials were downtrending. So, but the 3 that I focus on the most, I consider these the 3 leaders of the market. Any secular bull market advance will generally be led by the more aggressive areas of the market, because a secular bull market normally is accompanied by fairly low interest rates. That's what helps the economic boom to begin with. And with those lower interest rates, normally growth stocks thrive. They're able to grow their earnings faster than value companies. And with rates low, that's another benefit because you're discounting future earnings back. When you look at valuations, you're taking future earnings or future cash flows, whatever you want to look at, and you're discounting them back using current rates of interest. So when interest rates are low and the economy is strong, that's nirvana. And that's usually what you see during secular bull market advances. So I expect these three groups to lead. And so one of the reasons that I wrote about maybe some troubles ahead in 2022 was the relative weakness that we started to see during the last move higher in the S&P 500. Now we're downtrending. And so ultimately what I want to see is the opposite. These first three charts, I would really like to see them begin to show strength while the market keeps going lower. Well, the initial move to the downside right here, January through mid-March, you can see technology going along for the ride, discretionary going along for the ride. I mean, underperforming. So these groups are going down faster than the S&P 500. Communication services, same thing. Then we bounced. And normally when we bounce, we expect these groups to move back up again. And they do a little bit. Communication services, not so much. And then back down again. Now, if there's one silver lining, is that we're starting to see a little bit of strength. Here you can definitely see it in the industrials for the last month, relative strength. So that's one of the five that's starting to show some pretty decent action. Communication services was hit pretty hard, but it just recently, last couple of weeks, starting to show a little strength. Technology, is this the start of something? Probably a little too early to tell, but right here, we were pretty much even. These four bottoms. And if you look here, we were all lower. And then as we put in this latest low, technology actually, we've seen money begin to rotate. So this to me is just the start of something to watch. I'm not ready to say that it's over. I mean, look at consumer discretionary. Consumer discretionary took out these lows and getting close to the low we saw back in March. Not very good. Communication services just put in a new low, pretty steep drop throughout the month of April. So we're, again, turning back up again, but coming off of some pretty depressed levels. I would say industrial is the only one really at this point that's looking good. Now, on this next chart, what I've done is I'm showing you the same thing, except the four bottom panels are your defensive sectors. So you got healthcare, consumer staples, real estate, and utilities, all relative to the S&P 500. Now let's go back, make this 6 months. And there's that move on the S&P 500. And I want you to look to see what these defensive groups were doing in December. Healthcare was leading the S&P 500. Staples leading the S&P 500. Real estate leading the S&P 500. Utilities leading the S&P 500. So aggressive groups were underperforming. Defensive groups were leading as we were putting in that high. And this isn't me, by the way, going back and Monday morning quarterbacking. Go back and look. I wrote an article on December 31st. I had exactly the same information in there. In fact, I think in one of the articles I wrote, I shared a snapshot. Hold on one second. I shared a snapshot in one of my articles that showed the monthly performance of all the sectors. It was right at the end of December that I showed that. And the four groups leading for a month, I mean, this was the S&P going up for a month, and the four groups leading were all the defensive groups. That rarely happens, rarely. That is a really big warning sign. And the reason, normally when the S&P 500 is breaking up all-time highs, it's a good sign about our economy. Normally the technology group is going to be doing well. Well, in this case, Wall Street, beneath the surface, forget about everything you were hearing on CNBC about all-time highs and how wonderful life is. Under the surface of the market and behind the scenes, Wall Street was repositioning into defensive groups. During a rally, You normally see money rotating to defensive groups in a pullback. That's where you normally see more profit taking in technology and discretionary. Very normal during a pullback to see defensive groups lead. Very unusual during a 1 month rally to see all 4 defensive groups leading the market. That was a major warning sign. Now, in 2022, as we started to move lower, you can see healthcare, it's continued to do pretty well. Staples continuing to do very well. Real estate, even though it did have this nasty pullback recently, overall continuing to do pretty well. Same goes for utilities. So once again, right now, and we're in a downtrend, so I expect this. I expect to see these groups leading. But when we hit a bottom or when we approach a bottom, Wall Street is not going to wait for the market to go up and then start to get by technology. Wall Street's going to do at the bottom essentially what it did at the top. It's going to, behind the scenes, unannounced, begin to move into growth stocks. And all of a sudden, you're going to see interest rates going up and all these headlines about surging inflation and how bad it is in 1970s and stagflation and maybe even the Great Depression 2.0. Going to be talking about all those things. And meanwhile, if you look closely, you're going to start seeing growth stocks outperform. You're going to see consumer discretionary outperform consumer staples. Transports will outperform utilities. And if you're not paying attention to it, you won't even notice. If you do see it, you'll probably be scratching your head. Why are interest rates going up and money's rotating back into growth stocks? This doesn't make any sense. Well, it's Wall Street's way of saying the bottom is in, or the bottom is certainly approaching. So keep all of that in mind. One more set of ratios I want to do, and I'm going to go back 6 months on these as well, hourly. Now here's the S&P 500, same chart on top. Here we have the XLY, XLP, transports versus utilities, large cap growth versus large cap value, mid cap growth versus mid cap value, and small cap growth versus small cap value. I'm outside of transports versus utilities, and some of this is just a little bit of a bounce off of the steep decline. I mean, you're not going to go down every day. This is a series of lower lows and lower highs. But at least transports, this is why when I said industrials were looking pretty good for the last month, this is why transports have been performing better. But if you remember, we had a steep drop on truckers, we had a steep drop on railroads, and so they've stabilized while the market has come back down. So their stabilization has resulted in outperformance here over the last month. I don't believe they're out of the woods by any stretch, but that's what's causing this ratio to go up, and that's also what was causing industrials to outperform for the last month or so. So when I look at this chart, this ratio right here is my favorite ratio to watch. XLY, XLP. And it's really easy. The reason why is simple. Our economy is made up of 2/3 consumer spending. Think about that for a second. Nearly 70% of our GDP is consumer spending. These two sectors house the two key consumer areas, discretionary and staples. Discretionary, these are companies that sell us the things that we want. Staples they represent companies that sell us the things that we need. Want versus need. When the economy's weak, we're going to give up some of the things we want. We just don't feel like we can afford it. We're not going to give up the things we need, though. We're still going to buy toothpaste, I hope. And we're still going to buy soap. Same quantities we always did. Still need the same amount of soap. I don't know anybody, maybe there's some people out there that during a recession take less shampoo to wash their hair. I don't know. Maybe they consciously look and say, well, the market's not doing well. Maybe I'll only use half the shampoo I used yesterday. I don't think that's the case, but maybe there are. Maybe people do that. My point here is consumer discretionary stocks are going to do better in a strong economy when the market believes that the economy is going to be strong. Starbucks is going to do better in a booming economy than it is in a recession. It's just the way it is. Now, personally, for me, Starbucks is like a staple, but that's just me. I will be in Starbucks every day regardless. But the point is, most people, a lot of folks will start to cut back on discretionary spending when things get tighter. Staples, they won't, or at least they shouldn't. And so in a market uptrend, I always look for this ratio to give me that sustainability factor. Is the rally sustainable? Well, when we're going up and the XLY, XLP setting new highs, it's sustainable. When the market goes to a new high and the XLY, XLP is going down, that is a warning sign. And once again, that was occurring at the end of December. Another warning sign. Look at transports versus utilities into the end of the year, down. Look at these growth stock ratios. Large caps were holding up a little bit better, but they were going down. The mid cap growth going down, small cap growth going down. These are all versus value. All of this was occurring when the market was setting a new all-time high. Well, as we're moving lower and lower here and setting new lows on the S&P 500, many of these areas are still going down. This is what bothers me about the market. Now, does this mean the stock market can't rally for the next 5 days? No. Market can do whatever it wants. Market could bottom. We could be off to the races, never come back to this level. Even with these charts, this doesn't guarantee us anything. What we're doing with technical analysis is we're evaluating the probabilities. And based on what these sustainability ratios are telling me, especially my XLY, XLP, I mean, end of April, we were at a new low, going down right with the market. That is not a good look. And it tells me that the probability, that's why I say, I think maybe 75% chance we're going lower, maybe 80%. Not only lower, but maybe 3,800, maybe even down as low as 3,500. I would give maybe a 10% chance we're going to hit 3,500, maybe 25% chance that we're going to hit 3,800. Maybe I'm wrong, but so far this year, I've been pretty right as far as where we were, what we predicted at Market Vision 2022, and where we are now. I mean, it's literally almost right on cue. I think we're going to bottom. And I think the bottom is more likely, it could be September. I think it's more likely to be June. Maybe before we start into the second quarter earnings season, heading into July. I think we could bottom sometime at the end of June. Just again, maybe an educated guess. All right, earnings. Let's talk a little bit about earnings here. We got a couple minutes left. AMD, stock's up 7% pre-market, but it's been beaten down pretty good. The question is, we've seen a lot of these stocks that are not doing well, gap up above the 20 and then have a black candle come right back down, or a bearish engulfing candle, which would be red filled, and fail to hold the 20-day. So that the first test is getting through the 20-day. But look at these, look at all this support right at 100, right here, 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 and then the breakdown. And once we broke below 100, we have not been able to get back above it. So 20-day moving average is one level, but then you got price resistance at 100. Now, if we're up 7%, we're going to be up close, probably 97 and change is what it's looking like maybe at the open. So AMD got a little work to do. Starbucks, and by the way, AMD beat $1.13 on earnings. Expectations were 91 cents. Starbucks not as fortunate though. Expectations were 60 cents. They came in at 59 cents, but stock's up 7% pre-market. So this is looking to go up probably somewhere in the $5 range. So maybe 79, up near the 20-day. So kind of like AMD, it's going to be right at the 20-day. And then also this price resistance area. This was support coming across here, and we just lost it. Can we get back through, say, 79, 80 bucks? That's going to be the first test for Starbucks. How about Lyft? Talk about a stock needing a lift. Lyft beat. Expectations were a loss of 7 cents. They actually came in with a profit of 7 cents. And you know what the market is saying? I'm going to show you what the market is saying here in about 2 seconds, because the market just opened. I'm going to show you the reward that Lyft is getting for its earnings beat. There it is, down 27% this morning. But I think they were light on guidance going forward. I just saw headlines. I haven't had a chance to look at all the guidance on many of these stocks. Akamai, another one that taking it on the chin that today, down 12%. Akamai missed, came in at $1.39 on earnings. Market was expecting $1.42. Moderna had a huge beat on bottom line, 858 versus 518, and the stock's up 4.7%. After this lengthy downtrend, great numbers. Again, I didn't see revenue, I didn't see guidance, but stock only up 4% with that number. We'll see whether or not we can add to it, but the overall downtrend looks like it remains in play here for Moderna. Generac, GNRC, they had a pretty good beat, 209 versus $1.90. Stock's up 5% pre-market, or excuse me, now it's 5% during the market here. But it's still got the 20-day. It's got overhead resistance. It's got areas it needs to take out. So let's take a look at, for the three you must see. I already talked about AMD, but let's just do that one as well. Let's do it again, getting the real time. Well, there's a little bit of a black candle so far. It opened 98.18, currently at 96.97. I'm much more interested in how AMD finishes today than how it starts. And especially with the Fed coming out at 2 o'clock. We have the recipe here for fireworks after 2 o'clock today. The second one we'll go over, let's take a look at Match.com. Match down about 10% today, and you can see it's already been downtrending pretty badly. 74 cents earnings versus 66 expectation. So stock down 9, almost 10%, even though it did beat on the bottom line. And then the last one I'll show you is REGN. This is another one in the biotech area. They manufactured that cocktail, that famous cocktail for COVID. Anyhow, 11.49 is their earnings, and they were expected 9.37. And for all of that, stock's up 1/3 of 1%. But this one actually has been doing better. Had a nice breakouts, pulled back recently. Now appears to be in a little bit of a downtrend. Needs to get back through both those moving averages. So what's the market doing? Let's see, and we'll wrap this up. NASDAQ down 15, Dow up 7, S&P up 1. VIX is back down to 29. I'm not sure if that's good or bad. I wish the VIX was still, really elevated. Now it feels like it has room to go back up again while the market sells off. Or I guess you could say, okay, fear's coming out of the market, so we'll go higher. I don't know. Depends on how you look at it, I guess. Is it half full? Is that glass half full, or is it half empty? I'm nervous about the market. Just to conclude here, I went through those relative charts. Those are some of my favorite relative charts to watch. And none of them are getting me that excited. I do like that in the very, very near term, we're seeing a little bit of money rotate to technology. I'd like to see that continue, especially if we go back and keep setting lows in the S&P 500. If technology on a relative basis can hold its prior relative low, that would bode pretty well for the market. We could maybe see that bottom coming in. And if you followed all the talk that I've had recently in recent weeks about cyclical bear markets, we did a special on it, I think back in February, had a special event designed to show you what cyclical bear markets look like on the charts, so you can kind of get an idea of maybe what we could expect. What we've been seeing fits right in, for the most part, to these patterns of these cyclical bear markets. So we could be in for one more move to the downside. That's what we saw in 2018. Fourth quarter, remember the trade war? We went down 20%. It was one final swoosh to the downside in late December that put in the bottom. 1990, if you wanted to go back and look at history, 1990 would be a good period to cover and look at, because it was so similar to what we have right now. The Fed was turning hawkish. We had a war. We had the Gulf War. We had surging crude oil prices. We ended up having a recession. It was a mild one. The market bottomed before the recession was in the books. So, hey, I know the news is bad. Trust me, it ain't going to get better anytime soon. The news is not going to mark the bottom. Wall Street is going to mark the bottom with their rotation, with these relative strength, with these intermarket relationships, the things I was showing you today. That's what's going to mark the bottom. Anyhow, that's all I've got for today. Listen, be careful out there. Fed at 2 o'clock, anything goes. I could see a big sell-off. I could see a big rally. And honestly, you could flip a coin. I'm not quite sure which one. You would think with the VIX having just hit 36 and getting the Fed out of the way, that we'd kind of pave the way for a rally. We'll see. Anyhow, you all have a great day. I'll be back tomorrow over at Stock Charts TV at 9 a.m. tomorrow. Just come right here, hit Stock Charts TV, and my show will begin at 9 a.m. Eastern. Have a great day, everybody. Happy trading.